I think this is a challenging market. All markets are challenging, but this one in particular, because there is a bifurcation between companies that are still growing in this environment, in fact, have accelerated growth because the COVID-19 pandemic has actually accelerated trends that were already in place. So companies like Zoom, for example, have seen an incredible spurt of growth, bringing forward future growth that they wouldn't have had this soon but for the COVID example. That's happening in other stocks as well, and other companies as well. There are other companies like the airline companies, the hotel companies, some industrials, restaurants, retail, where we've seen significant impairment in value and a significant impairment in their fortunes. Those companies, however, have rallied pretty strongly. So the market itself as a totality is in a little bit of a risky position. A lot of momentum. The market will probably still continue to rise, but you'll have more volatility as that increase goes on. IPOs are a different story. You have to look at each IPO separately and decide whether the company is properly priced relative to its growth rate. And something like Zoom is the kind of company where it's had all this accelerated growth. And if the IPO is priced aggressively, that could make it challenging for that price to be, valuable over the next 6 to 9 months.
Sure, Peter. So what are you doing in this market environment? Have you been buying and are you keeping a balance between the overcrowded trades in defensives versus looking at some of the beaten down names that have been impacted because of COVID-19?
Well, actually, in the beginning of May, many of our portfolios were adjusting from growth-oriented companies, free cash flow companies, companies that benefited from this acceleration of existing trends caused by the pandemic, to companies that we think that have strong enough balance sheets, may have some leverage, stock prices beaten down, but very strong franchises that we believe will benefit from the recovery, which we think will ultimately happen later this year and into next year. So we've actually shifted a bit in terms of our emphasis, and that's been quite helpful in terms of how we've managed the recent very strong rotation from momentum to value that we've seen in the last few days. Today, there was a reversal of that, actually pretty strong reversal of that. And so you can see there's a lot of back and forth in the market. But we shifted away from some of those stronger momentum names to stronger recovery names, and that's benefited the portfolios and the clients that are invested in them.